Welcome everyone, and thank you for attending this seminar today on superannuation and in particular contributing into super. My name is Therese and I'll be presenting tonight's seminar. Now, in order for us to get through the content, I would ask that if you have any questions, that you leave these until the end. If you're attending online, we ask that you use the chat option at the top of your screen, and we will also try to address these at the end of the seminar. If we don't get to your question or feel that the question is more personal in nature, we will arrange for someone to contact you personally. Now, just a reminder that the information contained in this seminar can change and that the content is general in nature. As everyone has different personal financial situations, objectives and needs, you do need to consider this before making any decision. If you need advice that is tailored to you personally, then we have advisors that can assist you with this. We will provide their contact details at the end of the seminar. So what are we trying to accomplish in this seminar? We'd like for you to be able to walk away with a better understanding of the importance of contributing into super and how to do this, to provide you with some examples to increase your understanding, and if you're not sure, that we've had advisors that can assist you. Now, just remember, it's never too young to start to contribute. The earlier you start, the easier it will be for you to build up your super over time. Firstly, why contributing to super? Well, contributing into super will help you build up funds for your retirement. Okay, so why is this important? Well, it's important for a number of reasons. It can have an impact on how you live. The more money you have saved, the more you can do, and the higher your standard of living will be. The more money you have saved can also impact on when you retire. Do you want to have to work for longer simply because you don't have enough? Or what if you can no longer work due to health reasons? Or what if you would just like to help out with your grandchildren, but financially you also still have to work? But why super? Well, in retirement, your superannuation can be moved to a tax-free pension. That's right, a completely tax-free environment that pays you a regular income. Yes, there are some limits on the amount of funds that can be moved to a pension, but the limit is fairly generous. It's currently $1.9 million. So, what are contributions? A contribution is anything that increases the value of your super fund. Much like a bank account, when you deposit funds into a bank account, it increases its value. The main differences are that funds deposited or contributed into super are invested for your retirement. Contributions can be either employee contributions or member contributions. Let's start with employee contributions. These are contributions made by an employer. So the employer is making the contributions into your super fund. Employee contributions include mandatory employer contributions or contributions the employer must make, and these include contributions such as super guarantee contributions, or SG as they are known, and contributions paid into super by your employer as part of an award or agreement. We do get a lot of members asking, what are SG contributions? Well, basically, SG contributions are contributions that your employer must pay into your super fund. They're currently calculated at 11% of your ordinary times earnings, but this is going to be increasing from 11% to 11.5% on the 1st of July 2024. Now let's move on to employer voluntary contributions. These are contributions that your employer is not forced to make. They include contributions such as salary sacrifice contributions. Now, this is where you ask your employer to make contributions on your behalf from your pay, either before or after tax, or contributions which your employer has chosen to make in excess of their SG obligations. When employers make contributions into super, for example, the SG contributions that I mentioned previously they're obliged to make, they usually claim a tax deduction for the contribution. That is, it reduces the amount of tax that they pay. Now, as they claim a tax deduction for the contribution, it will be taxed at 15% going into your super fund. For example, if your employer pays SG contributions of $10,000 for the financial year, tax of 15% or $1,500 will be taken from your super account. Now, even though salary sacrifice contributions are classed as employee contributions, they are not deductible to your employer. That is, it does not reduce your employer's tax. Salary sacrifice contributions are not taken from their funds, as it is taken from your pay. Now, salary sacrifice contributions are taken from your salary prior to tax being paid or pre-tax. They can reduce the amount of tax that you pay each pay period. Should I salary sacrifice? Well, while salary sacrificing before tax can reduce your personal income tax, the contributions are also taxed at 15% going into your fund. Thus, your marginal tax rate plus the Medicare levy must be more than the contributions tax for there to be a tax advantage. We commonly get asked, should I salary sacrifice? And the answer is sometimes. It depends. In some cases, it may provide a benefit, but not always. And that's where personal advice is important, so that your personal circumstances are assessed. If you currently do not pay personal income tax, then it may not be the right strategy for you, and there may be better ways to contribute to super. Now let's go over member contributions. Member contributions are all contributed by the member personally or by you, and they're not employer contributions. That is, they are not payable by the employer, nor have you directed your employer to pay them via salary sacrifice. Member contributions include personal concessional or before tax contributions, personal non-concessional or after-tax contributions, downsizer contributions, spouse contributions, and child contributions. There are also other types of contributions, including those that you can make into super on the sale of a small business, which can reduce the capital gains tax payable, and contributions made by the government, including the government co-contribution and the low income tax offset. Now, personal concessional or pre-tax contributions are contributions that you make personally into your super fund and then claim a tax deduction for. They are also known as deductible contributions. They aim to increase your superannuation savings tax effectively or reduce your tax. Contributions tax of 15% is also payable on all personal concessional contributions you make into super. This is normally paid once you have informed your fund that you wish to claim a tax deduction by lodging a notice of intent form. Should I make personal concessional contributions? Well, once again, the suitability of making these types of contributions depends on your personal circumstances, and personal advice may be needed to ensure that these types of contributions are appropriate for you. One thing to note is that when making these types of contributions, you will not receive the tax benefit until such time as you lodge your tax return. Your super fund is required to again pay 15% contributions tax on all employer SG, any employer additional contributions, pre-tax salary sacrifice, and personal concessional deductible contributions once received by the fund. Now, if you're a high income earner, you may also have to pay an additional 15% tax on part or all of these types of super contributions. It is called Division 293 tax. This tax is payable by members whose combined income and concessional contributions for Division 293 purposes exceeds $250,000. It's not usually until after you lodge your return that you may be notified of this. Normally, you have the ability to pay this additional tax either personally or you may have it taken from your fund. If you're a low-income earner, then you may benefit from reduced tax on these types of contributions. If your adjusted taxable income is $37,000 or less, then you may be entitled to the low-income superannuation tax offset or LISTO from the government. The maximum LISTO is $500 and it's paid into your superannuation account and not to you personally. Now let's move on to personal, non-concessional or after-tax contributions. These are contributions that you pay personally into your super fund and do not claim a tax deduction for. That is, they do not reduce the amount of personal tax that you pay, but your fund also does not have to pay contributions tax. Their main aim is to build your super. Another benefit of making non-concessional contributions is that you may qualify for the government co-contribution. The government contributes to the superannuation accounts of low and middle income earners if they make a personal, non-concessional after-tax contribution to super in the financial year. The maximum contribution is $500 if you contribute $1,000 and your income plus reportable fringe benefits plus reportable employer super contributions is $43,445 or less. Any income above this amount reduces the amount of the government co-contribution and ceases once your income exceeds $58,445. There are some conditions though to qualify. The main ones are 10% or more of the member's income is attributed to employment or self-employment. You must be less than 71 years of age at the end of the income year, and you must lodge a tax return for the year. I've got a few examples here. Now, in example one, we have a member earning $37,000. They make a non-concessional contribution of $1,000 into super, entitling them to the maximum co-contribution of $500, as their income is less than the lower threshold of $43,445. Now, in example two, the member's income has increased to $47,000. They've also chosen to make a non-concessional contribution of $1,000. Although their income is less than the upper threshold, it is higher than the lower threshold, so the government contribution has been reduced to $382. Now, in example three, the member's income is the same as in example one, that is $37,000, but they've only made non-concessional contributions of $500, resulting in a reduced government co-contribution of $250. Now, let's look at downsizer contributions. If you are 55 or over, you can contribute into super all or part of the proceeds of the sale of you or your spouse's home up to $300,000 per person. Now, this means a couple could contribute up to $600,000 into super between them. There is no upper age limit for making these contributions, and before you ask, you are not able to claim a tax deduction for these contributions, but it also does not attract contributions tax going into your fund. There are some eligibility requirements. The first is the home must have been owned for 10 years or more prior to the sale. The contribution must be made within 90 days of settlement. You must not have previously made a downsizer contribution, and you must have lived in a home for all or part of the ownership period. So vacant land and investment properties that you've never lived in do not qualify. Spouse contributions. Now, spouse contributions are contributions that you make into, obviously, a spouse's super fund. Please note, no tax deduction will be claimed for the contribution, nor is contributions tax payable. You may be able to claim a spouse contribution offset of up to $540 by making a $3,000 spouse contribution if your spouse's income is $37,000 or less for the full offset or $40,000 for a partial. There are also a number of other conditions that need to be met, the other conditions being the receiving spouse has to be under 75 years of age. You must live together in a bona fide domestic relationship. and the contributor and spouse must both be Australian tax residents. The receiving spouse is also not able to exceed the non-concessional contributions cap. Again, we have a few examples. In example 1, we have your spouse earning $37,000 per year. You make a contribution of $3,000 into your spouse's super fund, entitling you to the maximum spouse contribution tax offset of $540 as your wife's income is $37,000 or less. Now, in example 2, your spouse is earning the same amount as in example 1, that is $37,000, but you've chosen to make a smaller spouse contribution of $2,000, resulting in a reduced spouse contribution offset of $360. And example 3, your spouse's income is now $40,000. You make a spouse contribution of $3,000, but as your spouse's income is $40,000 or more, there is no spouse contribution tax offset available as they've exceeded the income limit. Before discussing how much you can contribute into super, let's just go over concessional and non-concessional contributions briefly. Concessional contributions are contributions made by either your employer or you into super, pre-tax or before tax, and they are taxed at 15% when received by your fund. They include employee contributions paid by your employer, including SG, pre-tax salary sacrifice, and other employer mandatory or voluntary contributions. For member contributions, these are personal contributions where you have claimed a tax deduction. Non-concessional contributions are contributions made to super by your employer or you personally after tax. That is, there is no tax benefit to either the employer or you personally, and they're not taxed when received by your super fund. These types of contributions include after-tax salary sacrifice contributions, personal contributions where no tax deduction has been claimed, spouse contributions, and child contributions. There are other contributions that are neither classed as concessional or non-concessional, and they include downsizer contributions and contributions made under the sale of small business rules. Are there restrictions on how much you can contribute to super? There are consequences if you exceed limits that the government has set in place. These limits are called caps. If these caps are exceeded, you could be liable for additional tax. These additional taxes are generally enough of an incentive to stay within the limits set. Okay, what are the caps? Well, the general concessional contributions cap for 2023-24 financial year is $27,500. It is anticipated that this cap will be increasing to $30,000 from 1 July 2024. Now let's look at an example. So here we have an employee on $90,000 per year. His employer pays SG contributions to super for his employee of $9,900. That is his 11% SG. Now this employee also salary sacrifices $100 a week or $5,200 a year. So the total amount of concessional contributions for the financial year is $15,100. As the concessional contributions cap is $27,500, he is well within the cap and could contribute a further $12,400 into super either via increasing his salary sacrifice or making an additional contribution to super and claiming a tax deduction and still be within the cap. One of the reasons I did want to show you this slide is that a lot of members do not realise that the SG that their employer pays is included in the $27,500 general concessional contributions cap. Now, although the general concessional contributions cap is $27,500, you may have a higher cap. Why is this? Well, to assist those that have not been able to contribute in the past but are now in a position to do so, there is the ability to use prior years' unused concessional contributions caps if your total superannuation balance, or TSB, as at the 30th of June of the previous financial year is less than $500,000. You are able to use unused concessional contributions caps from the previous 5 financial years if you exceed the general concessional contribution cap of $27,500. Now, let me show you how unused carry forward contributions would accumulate if your total superannuation balance, or TSB, was less than $500,000 as at the 30th of June 2023. Now, firstly, as at the 30th of June, the member's superannuation balance was less than $500,000. This is very important. If it is over this, then the member cannot use any unused carry forward concessional contributions. That is, they are restricted to the general cap of $27,500. In the 23-24 financial year, the member has unused carry forward concessional contributions of $76,000. Well, how did we get to this figure? Each year that they did not utilise the full concessional contributions cap over the past 5 years, it has accumulated. If you look at the first column, we can see that in the 2018-2019 financial year, the general concessional contributions cap at this time was $25,000. So the maximum cap available was $25,000. Employer SG contributions of $9,500 were made, but no other concessional contributions. So at the end of this year, there are $15,500 unused concessional contributions accrued. Now let's look at the next year. In the 2019-2020 financial year, the general concessional contributions cap was again $25,000, but the $15,500 unused concessional contributions from the 2018-19 have carried forward to this year, making the maximum concessional contributions cap $40,500. You once again do not use the general contributions cap, nor the amount carried forward from the previous year. So this has again carried forward to the 2021, 22, 22, 23, 23, 24, resulting in total unused concessional contributions of $76,000 this financial year. As he also has the general concessional contribution cap of $27,500 for this financial year, his maximum cap is $103,500. Now we're going to look at an example where this same member wants to contribute more than the general concessional contributions cap in this financial year. In the example used, the member is earning $130,000. He has no other income. He has a total superannuation balance of $300,000, so is under the $500,000 required to access unused carry forward concessional contributions. The member makes personal concessional contributions in the financial year of $50,000 and doesn't exceed the cap, as he has unused concessional contributions. This reduces the taxable income from $130,000 to $80,000, and as a result of this, the amount of income tax they pay reduces from $35,767 to $18,067. That's a personal tax saving of $17,700. If they salary sacrifice this amount, the tax savings would be reflected in their pay each week, fortnight or month, depending on when they are paid. If they wish to make contributions personally and then claim it as a tax deduction, then the tax savings of $17,700 will not be received until after they lodge their tax return. Please note that in the example above, we have assumed that the member has private health insurance and does not have to pay the Medicare levy surcharge. Now, it's important to remember that as there is a tax benefit when the contributions are made into super, there is going to be 15% tax payable on the contributions going in. If you look at the example, you'll see that if the member did not make any concessional contributions to super, the member would pay $35,767 in personal income tax. He would also pay contributions tax on the SG contributions made by his employer of $2,145 from his super fund. Therefore, the total tax payable by the member personally and the contributions tax payable equates to $37,912. If the member made the $50,000 concessional contribution to super, then the member would pay $18,067 in personal tax, a reduction from $35,767. Contributions tax would increase from $2,145 to $9,645, as contributions tax is now not only payable on the SG contributions, but on the concessional contributions paid by the member. So the total tax saving is $10,200 for the financial year. It's also important to remember that if your combined income and concessional contributions for Division 293 purposes for a financial year exceed $250,000, then an additional 15% tax on all or part of the concessional contributions will be applicable. So a result of making the $50,000, you can see that the remaining unused carry forward contributions in the last column, or the 2023-24 financial year, have reduced from $89,200 to $39,200. A couple of things to remember. You can only go back 5 years. So if the member did not use his unused concessional contributions from 2018-2019 financial year of $15,500, in the 2023-24 financial year, or this financial year, they would no longer be able from next financial year onwards. If you've met a condition of release, most commonly attaining age 60, then you may be able to access additional funds through a transition to retirement strategy to enable you to build funds for retirement if you do not have the cash flow or available funds to contribute to super. We have advisors who can assist on the suitability of such a strategy. Now let's look at the non-concessional contributions cap. Remember, again, these contributions are made from after-tax money. Thus, there's no tax deduction, and no tax is payable when it goes into the fund. The standard non-concessional contribution cap for the 2023-24 financial year is currently $110,000. It's anticipated from 1 July 2024 that this cap will increase to $120,000. To be able to utilise this non-concessional contributions cap, a member's total superannuation balance must be less than $1.9 million as at the 30th of June of the prior financial year. If this is not the case, then the member's non-concessional contribution cap is nil. You may bring forward up to 2 years' worth of non-concessional contributions cap into the current year, allowing you to potentially contribute up to $330,000 without exceeding the non-concessional contributions cap. From the 1st of July, this could potentially be $360,000 due to the increase in the non-concessional contributions cap. Unlike unused concessional contributions, which look back at what you've done in the past, this looks to the future. In other words, if you've utilised all your bring forward contributions in this financial year, you'll be unable to make non-concessional contributions in the 2024-25 and 25-26 years. It is also important to note that the ability to utilise the bring forward rule also depends on your superannuation balance. Where you have exceeded the concessional contributions cap, the excess amount is included in your assessable income and taxed at your marginal tax rate. You do get a 15% non-refundable tax offset to compensate for the fact that there was 15% tax payable on the excess amount when it went into your fund. Basically, this just negates any tax benefit. You can elect to have up to 85% of your excess concessional contributions released from super. This can assist you to pay the additional tax on the contributions and also reduce the amount that's assigned to the non-concessional contributions cap. If you've exceeded the non-concessional contributions cap, excess non-concessional contribution tax of 47% is payable on the excess if it remains in super. But however, from 1 July, excess non-concessional contributions plus 85% of an associated earnings amount will be released from super where possible to try and prevent a taxpayer having to pay 47% tax on the excess. However, 85% of the associated earnings is going to be assessable income and taxed at your marginal tax rate, less a 15% offset. There's nothing stopping you from keeping the funds in super, but you will pay tax of 47% on any excess. Can anyone contribute to super? Good question. There are some age-based eligibility rules that must be satisfied in order for a fund to accept contributions. If you're older, there is good news, as these were relaxed on the 1st of July 2022. If you're under the age of 75, then a fund can accept any employer contributions or personal contributions. In the past, you had to meet a work test once you were 65 or older to contribute. Unfortunately, if you're aged 67 to 74 and you want to claim a tax deduction for any contribution you make, you will still have to meet the work test or a work test exemption in the year the contribution is made to be able to claim the deduction. If you are 75 and over, then only mandated employer contributions and downsizer contributions can be accepted. There is a little bit of a grace period of 28 days after the end of the month in which you turn 75 for non-mandated employer contributions to be accepted by the fund. Well, if you want to contribute to your NESS Super, you can simply log in online to your account and use the unique BPay details on the payment options page. If you wish to salary sacrifice, then this must be arranged with your employer. And don't forget, a member services team is available 8:30 a.m. to 6 p.m, Monday to Friday, to help you with all your super needs. We are hoping that some of the things we have discussed today have increased your overall education around contributions. We don't expect you to be able to know everything and not have further questions in relation to this content. At NESS, we have advisors who are willing to assist you to relate this information to your own personal circumstances and hope that you feel comfortable reaching out to us. Good news is the advice is simple advice relating to your NESS Super account. The cost of this advice may be covered by NESS. Okay, now this slide has the details of our two financial advisors, myself, Therese Pontifex, and Hernan Reyes. We really would love to hear from you. Now, for those of you who have attended in person, we provided some feedback forms which you've handed to you today. We'll collect them at the end of the seminar. If you have attended online, we will have feedback questionnaires for you to complete sent out to you soon. Please take a couple of minutes to complete these forms and provide us your feedback. Whether it is good or bad, it will help us develop better seminars in the future, and we really want to hear from our members. Thank you for your attendance.